In this week's episode of the Stock Scores Market Minutes, I'm going to answer the question, should we diversify? I'll then do my regular weekly market analysis, give you an outlook on the week ahead so that you can trade this crazy market volatility with success. All right, so should we diversify? What is diversification? It's a common approach to risk management for a stock portfolio. And what you're basically doing is buying a relatively large number of stocks across different industries, and really not even just stocks, but bonds and different asset classes. And the idea is that you are spreading your risk out by not putting a concentration into any one area. In other words, if the oil industry is collapsing, if you only have one oil stock out of 15 in your portfolio, then your overall portfolio shouldn't do too poorly because of that bad performance of the one bad sector. I'm actually not a big fan of diversification. I think that it means that you're ultimately just going to earn what the market earns. It's difficult to beat the market. It's also the case that when the market corrects, just about everything goes down together. So as a risk management technique, it's not really that effective when we have these big corrections like we've had over the last few months. In my mind, the better way to the better way to manage risk is to simply limit the losses on the holdings that you have. We really should just do good analysis and avoid bad trades, but we are always going to have some losses. It's inevitable that we're going to make mistakes, and when we do, we should limit the size of our losses and therefore not let any one holding really have a big negative effect on our portfolio. Good traders really shouldn't diversify. They should follow good analysis and trade the best opportunities as they come, but with the recognition that you're going to be wrong some of the time, and when you're wrong, limit the size of your losses, get out, and move on to the next trade. All right, let's get into this week's analysis, starting us off with the US markets, as I always do. I've been on vacation the past 3 weeks, have not been trading, and so I haven't really enjoyed the wild moves in the market. They've been great for day trading, perhaps not so great if you are a longer term investor. But let's take a look at the chart, starting with the chart of the S&P 500. Now last week, I talked about this level of resistance being the critical one that we needed to see a breakout from. And we actually got that pretty much right away, and the market has moved up since then. We're now building another line of resistance here. We have optimism. How do we know we have optimism? Because there are rising bottoms. Now that's optimism in the short term. We'll talk about the long term in a moment. So for now, the market is working on that bounce back from being heavily oversold, which is where we were back there. We've been building rising bottoms, so that's a sign of optimism. And now the critical thing is, do we break out through that resistance level at just under 260 on the SPY? If so, we should make another leg up. I think that the next level of resistance will be just under 270, the highs from back here. So short term, market looks decent as a short term trade. However, we are going to run into some longer term resistance, and this is where we have to take a look at that longer term weekly chart to get a sense of where that longer term resistance is. So here is the downward trend line. Now I talk about this a lot. When markets fall away from the trend line, they usually come back to it. We fell away from the trend line. We're now working on coming back to it. Remember that I said that the next level of resistance will be around 270. Well, that's also where that downward trend line more or less is if you look out a week or two. And therefore, I think that we have still some upside here, and short-term traders can take advantage of the bounce, although we're kind of well into it now. But don't get too bullish, too cocky, because when the market comes up to that 270 level, it's going to face some selling pressure, and it will probably roll over and move lower again. Now, that doesn't mean it'll go to new lows. Typically, a bottom is a process of first a bottom and then a move down to form a rising bottom, and then make a stab at breaking that downward trend line. So very short term, I think the market is more likely to go higher than lower, but looking out more than a week or two, we're going to encounter that longer term resistance, which will be a real test for the bulls, something we need to keep an eye on. Looking at the Russell 2000, it has bounced back quite nicely as well, but it is coming up to the downward trend line on the daily interval, and therefore probably will pause. It could have a couple more up days, but it's going to find some resistance up at this trend line here, and that's something to keep an eye out for if you are trading those small cap stocks. On to the Canadian markets. We have also a pretty good bounce back in the Canadian market, probably better in the last week, mostly because oil has stabilized and in fact moved higher, and that has helped the energy sector in Canada, which has got a heavy concentration on the TSX index. So that's one of the reasons we have this nice upward price action. However, we're still, faced with a lot of resistance levels, these horizontal lines of resistance that will prove to be barriers for the bulls to push the market higher. How much higher can it go? Again, let's take a look at that longer term chart. And here you can see we're pretty much hitting that downward trend line. So, we've had a little bounce back in oil. We'll look at that in a moment. I think if that doesn't last, we probably see a little bit of a pullback in the Canadian market near term. Hopefully it builds a rising bottom, and then it tries to make another stab at breaking that downward trend line. That's what we want to keep an eye out for. All right, moving along to the TSX Venture. Well, we've had a little resurgence in the cannabis sector, and that has helped this index move up over the last couple of weeks. But again, we always have to keep an eye on where those trend lines are, and we are still in a downward trend. We were oversold. We're coming back to the trend line. Again, likely that we'll see the market pause near term. Doesn't mean that it's over. It just means, we've had 2 weeks of upward move. Wouldn't be surprised if we see a little bit of downward price action in the short term, and then hopefully, again, building a rising bottom and trying to break that downward trend line. So for now, I think if you've played the bounce, you might want to think about taking profits and then look at getting back again later on if there is a pullback. Currencies, US dollar has been moving lower over the last 3 weeks. We've talked about that each of the last market minute videos, and it probably is pausing here. You can see that it managed to close essentially where it opened last week, coming into the congestion of this old trading range. So that should give the market some support in the US dollar. I think the US dollar could make a little bit of a move up again. The question now, though, is does it make a falling top? So there's the high. If it does move up and then forms a falling top and rolls over, then we'll have to be bearish on the US dollar. So for now, I'd call it neutral, but something to keep an eye out on there. Canadian dollar has had a good resurgence the last couple of weeks because of that stabilization in the oil market. Again, we'll look at that in a moment. But there is the downward trend line. We were quite oversold. We're now moving back up towards the trend line. There could be another penny and a half of upside against the US dollar for the Canadian near term. But again, short term, it probably maybe has one more up week and then starts to pull back a little bit. And hopefully we'll build a rising bottom if oil can stabilize and then make that attempt at breaking the downward trend line. On to interest rates. As I talked about last week, the bounce back in the bond market, which has been pretty strong, is now coming up to this resistance level. And we saw this week a little bit of profit taking in the bond market, which means interest rates ticked up slightly. Interest rates are still low relative to where they were 2 months ago, but we're probably in a case where we maybe pull back a little bit near term. Ultimately, I think we're going to go sideways under this resistance level, building that cup and handle pattern. And then perhaps a month down the road, we'll break out through that. And that would be a bullish sign for the bond market, and bullish if you're looking to mortgage a home or something like that, because interest rates will move lower. However, we could also just continue lower and move to new lows. That's probably not what will happen, but it's possible. Something to keep an eye out. For now, I think we're sideways in the bond market. Commodities. Well, of course, gold has been faring well while the market has corrected as investors looked for some safety. But even when the stock market has been moving up the last few weeks, gold really hasn't pulled back. So I think there's something else going on in the gold market, as we are still seeing strength in gold. And really, it's not going to encounter resistance until those levels there, which we hit a number of times. We've been building rising bottoms towards it. Yeah, we may pause along the way, but I think there's still some upside in gold before it hits that critical resistance level. I'll change my mind if the upward trend line is broken, but for now, I would be relatively bullish of gold. Not hugely so, because there's not a lot of upside there, but there is still some upside to go. Onto the oil market, I talked about oil showing some stability, and here's the daily chart, which really drives this home. We had a very long and steady downward trend without a lot of interruption, but we've actually broken that now. So that's step one in the bottoming process. Step one, break the downward trend. The way downward trends are typically broken is you have a downward trend line, you break it, that's step one. You then pull back and make a rising bottom, that's step two. And then you go sideways and break from that sideways rising bottom, that's step three. So we're at step one right now. That's early in a turnaround. It's by no means guaranteed that we will continue higher from here. We need to go through step two and step three before we can call this downward trend over. So step one is good, but there's still more work to do. So my ratings then, same as last week, bearish on both time frames long term because we're still in the downward trend, but neutral short term, bullish on both time frames for gold, oil bearish on both time frames. You could almost take that short term rating up to neutral now. I think that's probably better. Let me just, I'll write that in for you here. We're going to go neutral on oil in the short term because we have broken that downward trend line. But as I said, there's work to do there. Stock markets continue to move up from oversold conditions and they should continue higher in the near term. However, they will soon face resistance at that downward trend line, and that'll prove a test for the bulls and will likely bring a pullback. Now, oil is showing early signs of bottoming, but as I said, we're only in stage one, so we need to be cautious. Gold stable, moving higher. That looks pretty good. So I'll be back to normal with my market minutes video next week. I've been off from trading for a few weeks, but I will be back trading and we'll start to uncover some of the trades of the week and some stocks to watch next week. So join me then. Hopefully you've enjoyed this video, found it educational. If so, please click on that like button, subscribe to the channel, and most importantly, trade well.